Welcome. The purpose of this video is to give you an idea of what's required for submission 1 of the financial planning project. There's also things written about this at the very end of slide set 2 that we did in class, the tax slides, and also on the syllabus itself. But I wanted to put together a little video to be helpful to kind of give you an idea of what's expected. And so this is due. Whatever day exam 1 is, it's due at 11:59 p.m. that day. So if exam 1's on a Wednesday, at 11:59 p.m. on that Wednesday, this project, or submission 1 anyway, is due. It is graded. The project's 20% of your course grade, and so 3 of those 20 points is from submission 1. Submission 2 will be 3 points. Submission 3 will be 4 points, and then the final submission, the final comprehensive financial plan that you turn in at the end of the semester, will be worth 10 points. So it all adds up to 20 points. So what you're working on here is going to account for 15% of your project grade. So here's what you need. You need the group names, the student names. So 4 people in a group. You want to put the 4 students' names. Maybe you'll name your group. Some of my past students had the name of a group and of their group, like the financial advisors of Ramapo, and then they put the 4 student names below. So you got to have that. Only one of you needs to turn in the project because given that it has your names on it, I only need 1 copy of it. Then what you need to do is you need to put in your fictitious family. And so always have a child. It's important to have a child. And the reason is that we're going to do education planning. So for that reason, we need your fictitious family to have a child. It could be a single person or married and so on. And so, for example, I might have Judy Levine. She's 42 and she's self-employed, making $80,000. The reason I put self-employed in here is that makes a difference, as you know, when we do the FICA taxes. Bob, her husband, Bob Levine, is 41. He makes $75,000, and he's employed at a school or a company, whatever you want it to be in your example. And then Bobby is a 3-year-old child. And so then we move to the engagement letter. The engagement letter, now we covered that in class. Worksheet 1, pages 26 to 31. We had 7 elements of an engagement letter. And remember at the end of the letter that you write, the client needs to sign it and return it. So you need to put a spot at the bottom where the client says, I've read this, I understand it, and they sign their name and return it to you. That becomes the basis of your client engagement. And so you might be thinking, I wonder what it should look like when you're setting up your Word document. Well, by all means, become inspired by an example of an engagement letter online. So what am I telling you? Go to Google and put in example financial planning engagement letter and just see what they look like. You can never copy it word for word. That would not be good. But you could certainly read one and become inspired. Let it inspire you to make one that you think would be good. The next thing we're going to do is an amortization schedule. This is very important for a finance major to know how to do an amortization schedule, especially in Excel. And so you're going to learn that. What you're doing here when we do this is needed for submission 1, but we're also going to use it for submission 2. And so let's see what we're doing. So what I first did is I came up with loan information. So you and your group have to do this and communicate, because if you're working on different parts of it, you all have to know what the information is. You don't want the information on the loan here to be different than it is next month when you're turning in submission 2. And so my client here bought the house in 2008. That makes sense. That's about 12 years ago right now. So it does make sense that they bought it in their late 20s. That would not make sense if your clients were 25 years old. They probably weren't married buying a house when they were 13. And so be real clear when you're doing this. Like, make sure your project makes sense. It doesn't imply something odd. The house cost $420,000. The down payment was $84,000. So that means they financed $336,000. 420,000 minus 84,000 is 336,000. The interest rate's 3.2% and the term is 30 years. A 30-year term loan, that means we're going to pay for 360 months, given there's 12 months in a year. So let's put in the month numbers. You have month number 1, month number 2, and I'd be here forever like that, right? So what I could do is I could come up here and I can highlight these two numbers. So I came here and I left clicked, I highlighted those two numbers, come over here. See how that's a big wide white cross? When it switches to a thin black cross, double click with your, or just push down on the left left click it, and then drag. See how I'm down to 14 and down to 16, and then just pull it down and you could see it count right there. I'm up to we're at 158. We want to go to 360. So keep going with the left, having pushed the left click, you're left clicking, and you come down to 360. That's the number of months. So that's done. Not hard to do at all. That's a lot easier than writing them in. The next thing you want to do is you want to figure out the actual months and years. If your client bought a house in August of 08, the first payment is due a month later. So I'm just going to put in September 2008, and I'm going to put in October. I must have put in 09 by mistake. It's September 2008, and then the next month is October 2008. And once I have 2 in there, Excel knows the pattern. So I'm going to come here, left click, drag down in the middle of the cell, come over here, and as soon as you get that thin black cross, double left click twice. Double click the left on the mouse. And there you go. So now I have all the months and years. The next thing I'm going to do, I'm going to work on the math part myself. The beginning of the amount is the amount that you financed. So I'm going to put in equals this cell. The next thing I'm going to calculate is the payment. Now, the payment, put in the equal sign, open parenthesis, equal sign PMT, open parentheses, and what just appeared is this right here. It tells you the rate, the number of periods, the present value, and that's all we need for this type of a loan. If it were a loan with like an annuity due, it would be a little different. But so let me show you how to do this. You come up, you get the rate, and divide it by 12. That's exactly how the banks would do this. We're going to get the exact number a bank would get. Take the number of periods, multiply it by 12, and then put in a subtraction sign or a negative, and add in the amount financed. Close parentheses, and there you go. That's the payment. Now, that's the payment every single month. So what I would do is I'd come here, left click, right in the middle of that cell, come over here, and watch what happens when I drag this down. We're going to have a problem that we're going to fix. I get this. Well, what's happening is when I drag this down, you're seeing what's happening is the rate is going to this, to here. It's going down one. The amount financed is going to here. So everything's getting dragged down when I drag that down, and I don't want that to happen. In other words, when I do the payment down here for the subsequent months, I want to use the same information. So go back to the first box where you did the payment, come up here to the top, see where I'm at up here? And for every column, which is column B, this information's in column B, for every column, wrap the B with a dollar sign. So I'm going to wrap all these B's with a dollar sign. And that way, when I drag down, it will hold on the correct information. So there's 3 B's there. I'm wrapping each of them with a dollar sign. Now watch. When I drag this down, I get the correct number. The monthly payment doesn't change when you have a mortgage. Now, the interest the first month, I'm going to take equals the interest rate divided by 12 times the beginning amount. Again, I better go back. So I'm going to go back here. And I better wrap, see, I'm back up here again, wrap the B with a dollar sign. We're going to let the C go down from C12 to C13 because it always works off the beginning amount, but wrap the column B with a dollar sign. And so the interest the first month is $896. So what's going on here? The family's paying $1,453.09 per month, the first month it pays that amount. The interest that month, which works off the beginning amount, because I multiplied the interest rate divided by 12 times the beginning amount, is $896. The rest of that payment, where does that go? That goes to actually paying down the balance of the loan. So I'm going to take the payment minus the interest is the principal. So what's going on here is now I have the interest and principal. The payment is behind the scenes on a loan is divided between interest and principal. The ending payment is the beginning amount minus the principal. So if the family were to call up just after paying the first payment, the bank now has the first payment, and they asked, what's the payoff on our loan? This is the amount, $335,442.91. So you could even write this. This is the payoff for any month. This is the payoff of the loan. The ending amount is also could be called the payoff. Now, the ending amount at the very end of the month is next year's beginning amount. So I'm going to go here, and I'm going to reference, I'd put in equals, and then just click on the last month's ending amount. So now, it's easy now. Now we just come up here, double click. Don't worry about those zeros, they'll fill in a bit. Come up here, double click. Notice the payment's always the same. Come over here, double click. And when I go down to the very bottom, I'll see that the ending amount at the last month is 0. And that gives me a pretty good indication that I didn't make a mistake. If I got a positive or negative number down there at the bottom, the last number in row G here, that would indicate that I messed up. And so now what I want to show you is the reason that we did this, at least for submission 1, and we're going to use this again when we do submission 2, so save it. But the reason that, and you need to turn it in, but the reason I'm showing you this is for tax, which we're going to do next for submission 1. You need the annual interest payment, the sum of it, for the tax year. That's why I have this over here as well. So I'm going to highlight that, and I'm going to come down here to 2019. I'm going to assume that you're working on the tax year 2019, and I'm going to add up all the interest. Notice here I put an equal sum, open parentheses. Then all you have to do is come over here. See where the box is there on January's amount? Left click, drag through December, release the left click, put in a close parentheses like that. So that's the interest that the family paid. The total payment they made is higher than that, right? They paid $453.09 12 times, right? So they actually paid $17,436.06. But that's not what the government allows us to write off. They only allow us to write off the interest, the amount that we paid the bank, not the amount that we reduced the loan about, not the principal. So that's I could put here ID for itemized deduction. And so that's the end of the amortization schedule. So we'll see what's left here. You need to compute the family's federal income tax. Now, we did that in class. Slide 39 on worksheet 2 is the family's federal income tax. And so there's a part in there called state income tax. And so we don't know how to calculate that. We didn't teach that in this class, the state income tax. So what you could do is just use an estimate of 5%. Add the Judy's income and Bob's income, or if you just have a single person in your household, just take the income that the parent or parents make and multiply it by 0.05. Just an estimate, I realize that. Then try to figure out what the value of the house would be today and multiply that by 0.02. Like an estimate, and that would be the property tax. You need the property tax. So the property tax would be like an estimate that's pretty good, I guess, is 2% of the value of the house today. And an estimate of the state income tax is 5% of the family's combined income, given there's two parents, the combined income. And then the next thing that you'll do after that is the FICA taxes. And that's why you really need to know whether they're employed or by themselves, self-employed, or employed by like a company or a government entity. And so, because as you saw in class, that matters when you're doing FICA. Now, I did a FICA worksheet that you could use as an example for Robert in our class. We used a guy named Robert, and that's on slide 46 of worksheet 2. For his wife, Donna, you could look at slide 48 on worksheet 2. And so when you're doing this and you're having questions, which you could certainly have questions, please ask me. Send me an email, see me after class, before class, ask during class. It's best for everybody if you ask questions. You'll learn it a lot better, you'll get a higher grade, and you'll also be more satisfied. You're not expected to know everything. You're expected to kind of struggle through it when you do this because you're new at it. And so feel free to ask me questions. And I hope this has been helpful. And as always, I appreciate your feedback. And good luck with it.